everyone, today we are going to discuss all about investment management. We are the Group 1 reporters together with my teammates Stephanie Nazaro, Dayan Madalora, Mayroria Joshan Faith Adora, Julian Wee, and I am the first reporter, Rosemary Goodpan. So, here is the content of my report. Part 1, Investment Management. Part 2, Industry Scope. Part 3, Key Problems of Running Such Business. Part 4, Representing the Owners of Shares. Part 5, Size of the Global Fund Management Industry. So Part 1 is Investment Management. Investment management refers to the handling of financial assets and other investments, not only buying and selling them. Management includes devising a short or long-term strategy for acquiring and disposing of portfolio holdings. It can also include banking, budgeting, and tax services and duties as well. Next, investment management also is the professional asset management of various securities, including shareholdings, bonds, and other assets such as real estate, in order to meet specified investment goals for the benefit of investors. Investors may be institutions such as insurance companies, pension funds, corporations, charities, educational establishments, or private investors. Either directly by investments, contracts, or more commonly via collective investment schemes like mutual funds or exchange-traded funds or REITs. So investment management is on how to properly manage the investment of an investor to meet the specified investment goal of the investor. Next, so the term asset management is often used to refer to the management or investment funds, while the more generic term fund management may refer to all forms of institutional investment as well as investment management for private investors. Investment managers may specialize in advisory or discretionary management on behalf of normally wealthy or private investors, may often refer to their services as money management or portfolio management, often within the context of private banking. Wealth management by financial advisors takes a more holistic view of a client with allocations to particular asset management strategies. So in investment management, we have this what we call the investment manager. So investment managers are the people who handle all the activities related to financial planning or investing and managing a portfolio for individuals or organizations. So, ano nga ba ang hinahawakang portfolio o ano nga ba ang portfolio na hinahawakan ng investment manager? So, a portfolio is a collection of financial investments like stocks, bonds, commodities, cash and cash equivalents, including closed-end funds and exchange-traded funds. The term fund manager or investment advisor in the United States refers to a both firm that provides investment management services and to the individual who directs fund management decisions. According to Boston Consulting Group study, the assets managed professionally for fees reached a a historic high of 62.4 trillion US dollars in 2012 after remaining flat since 2007, and were then expected to reach 70.2 trillion US dollars a year later. The five largest assets managers are holding 22.7% of externally held assets. Nevertheless, the market concentration measured by the Herfindahl-Hirschman index could be estimated at 173.4 in 2018, showing that the industry is not very concentrated. So, they seek to make clients' money grow so that they can achieve their goals and aspiration to help offer a more comfortable future. So, part 2. Industry scope. The business of investment has several facets. The employment of professional fund managers, research of individual assets and asset classes, dealing, settlement, marketing, international auditing, and the preparation of reports for clients. The largest financial fund managers are firms that exhibit all the complexity their size demands. Apart from the people who bring in the money or the marketers and the people who direct investment, the fund managers, there are compliance staff to ensure accord with legislative and regulatory constraints, internal auditors or various guides to examine internal systems and controls. Financial controllers to account for the institution's own money and costs, and computer experts and back office employees to track and record transactions and fund valuation for up to thousands of clients per institution. So, industry scope is ito yung mga different scope ng pag-i-invest. Ito yung nandito yung mga tao na kung saan kasali o kabilang sa investment management. So, part 3. Key problems of running such business. So, there are 5 key problems in running a business. Number 1 is revenue is directly linked to market valuation. So, a major fall in assets prices can cause a precipitous decline in revenue relative to cost. So, if this will happen, you will make a loss. Number 2. Above average fund performance is difficult to sustain, and clients may not be patient during times of poor performance. As an investor, we seek to ask questions what happened to our investment, and especially if this case will happen, that the performance is difficult to sustain. Next. Number 3. Successful fund managers are expensive and may be headhunted by competitors. Of course, if investment managers is very successful in doing such things, they have expensive fees. 4. Above average fund performance appears to be dependent on the unique skills of fund manager. However, clients are loath to stake their investments on the ability of a few individuals. They would rather see a firm-wide success attributable to single philosophy and internal discipline. And the fifth one is analysis will generate above average returns often become sufficiently wealthy that they avoid corporate employment in favor of managing their personal portfolios. So that is the key problems in running a business. Part 4. Representing the owners of shares. Institutions often control huge shareholdings in most cases. They are acting as fiduciary agents rather than principals, direct owners, or the direct owners. The owners of shares theoretically have great power to alter the companies via the voting rights to shares, carry and the consequent ability to pressure managements and, if necessary, outvote them at annual and other meetings. However, there is the problem of how the institution should exercise this power. One way for the institution to decide, the other is for the institution to poll its beneficiaries, assuming that the institution polls should be then 1. Vote the entire holding as directed by the majority of vote cast. 2. Split the vote, or where this is allowed according to the proportions of the vote. Or 3. Respect the abstainer and only vote the respondent's holding. So, part 5 of my report will be the size of global fund management industry. Conventional assets under management of the global fund management industry increased by 10% in 2010 to 79.3 trillion. Pensions assets accounted for 29.9 trillion of the total, with 24.7 trillion invested in mutual funds and 24.6 trillion of insurance funds together with alternative assets, sovereign wealth funds, hedge funds, private equity funds, and exchange-traded funds, and funds of wealthy individuals. Assets of the global fund management industry totaled around 117 trillion. Growth in 2010 followed a 14% increase in the previous year and was due both to the recovery in equity markets during the year and an inflow of new funds. The US remained by far the biggest source of funds, accounting for around a half of conventional assets under management, or some 36 trillion. The UK was the second largest center in the world and by far the largest in Europe, with around 8%. So that's all of the content of my report. Thank you and have a nice day.
Good day, everyone. I am Stephanie Nazaro, the second reporter. Report content. From part 1, we have philosophy, process, and people. From part 2, we have the basic of investment management. Part 3, running an investment management firm. And part 4, pluses and minuses of investment management. Part 1, philosophy, process, and people. The consulting industry seized upon the 3 Ps as a method to explain the ever so elusive alpha. A manager's philosophy, process, and people were assumed to predict the organization's ability or inability to generate alpha. The 3 Ps, or philosophy, process, and people, are often used to describe the reasons why the manager is able to produce above average results. The first P is philosophy. Refers to overarching beliefs of the investment organization. Some sample questions are: does the manager buy growth or value shares, or a combination of the two, and why? Do they believe in market timing and on what evidence? And lastly, do they rely on external research or do they employ to a theme of researcher? The next P is process. Process refers to the way in which the overall philosophy is implemented. For example, which universe of asset is explored before particular assets are chosen as suitable investment? Second, how does the manager decide what to buy and when? Third, how does the manager decide what to sell and when? Fourth, who takes the decision and are they taken by committee? Fifth, what controls are in place to ensure that a rogue fund, one very different from others and from what is intended, cannot arise? The last P is people. People refers to the staff, especially the fund managers. Some sample questions are who are they, how are they selected, how old are they, how report who report to whom, how deep is the team, and do all the members understand the philosophy and process they are supposed to be using, and most important of all, how long has the team been working together? This last question is vital because whatever performance record was presented at the outset of the relationship with the client may or may not related to have been produced by a team that is still in place. Whenever a past recommendation failed to meet expectations, the consultants could always assemble a story that one of the three P's had broken down. Typically, insights excuses that the consultant might offer for a management disappointment are they lost a key analyst. Whenever a past recommendation failed to meet expectations, the consultant could always assemble a story that one of the three P's had broken down. Typical insight excuses the consultant might offer for a management disappointment are they lost a key analyst, they have strayed from their philosophy of growth at a reasonable price, and lastly, they have switched from a top-down to a bottom-up screening process. Part 2. The Basic of Investment Management. Professional investment management aims to meet particular investment goals for the benefit of clients whose money they have the responsibility of overseeing. This client may be individual investors or institutional investors such as pension funds, retirement plans, governments, educational institutions, and insurance companies. Investment management service includes the following. Asset allocation. The different asset class definitions are widely debated, but four common divisions are stocks, bonds, real estates, and commodities. The exercise of allocating funds among these assets and among individual securities within each asset class is that the investment management firms are paid for. Research suggests that allocating among asset classes has more predictive power than the choice of individual holdings in determining portfolio return. Next is statement analysis. It is the process of analyzing a company's financial statement for decision-making purposes. External stakeholders use it to understand the overall health of an organization as well as to evaluate financial performance and business value. Next is stock selection. It is when an analyst or investors uses a systematic form of analysis to conclude that a particular stock will make a good investment and therefore should be added to their portfolio. Stock selection is also known as active management. The position can be either long or short and will depend on the analyst or investor's outlook for the particular stock price. Next is monitoring of existing investment. It is important because it can bring your asset allocation back in line. Over time, asset allocation can change because of the way your investment perform. For instance, you have 10% of your money in shares, but if they do particularly well, they could account for a bigger slice of your overall portfolio a year later. Changing value of your investment means that your asset allocation may no longer match your investment goals, so you'll need to make an adjustment. And lastly, portfolio strategy and implementation. Implementing our portfolio strategy originates with determining appropriate allocation between equity and fixed income for each investor. Getting this decision right is absolutely critical to long-term investing success. Investment management in, may also include financial planning and advising services, not only overseeing a client's portfolio, but coordinating it with other assets and life goals. Professional managers deal with a variety of different securities and financial assets, including bonds, equities, commodities, and real estates. The manager may also manage real assets such as precious metals, commodities, and artwork. Managers can help align investment to match retirement and estate planning as well as asset distribution. Part 3. Running an investment management firm. Running an investment management business involves many responsibilities. The firm must hire professional managers to deal, to market, to settle, and prepare reports for clients. Other duties includes conducting internal audits and researching individual assets or asset classes and industrial sectors. Aside from hiring marketers and training managers who direct the flow of investments, those who head investment management firms must ensure they move within legislative and regulatory constraints, examine internal systems and controls, account for cash flow, and properly track records, transactions, and fund valuation. In general, investment managers who have at least $25 million in assets under management (AUM) or who provide advice to investment companies offering mutual funds are required to be registered investment advisor or RIA. As registered advisor, they must registered with the Securities and Exchange Commission or SEC and state securities administrators. It also means they accept the fiduciary duty to their clients. As a fiduciary, these advisors promise to act in their clients' best interest or face criminal liability. Firms or advisors managing less than $25 million in assets typically registered only in their states of operation. Investment managers are usually compensated via a management fee, usually a percentage of the value of the portfolio held for a client. Management fees range from 0.35% to 2% annually. Also, fees are typically on a sliding scale. The more assets a client has, the lower the fee they can negotiate. The average management fee is around 1%. Part 4. Pluses and minuses of investment management. The revenue of investment management firms are directly linked to the market's behavior. This direction connects means that the company's profit depends on the market valuations. A major decline in assets prices can cause a decline in the firm's revenue, especially if the price reduction is great compared to the ongoing and steady company cost of operation. Also, clients may be impatient during hard times and bear markets. Even above average fund performance may not be able to sustain a client's portfolio. Pros of investment management: professional analysis, ability to protect portfolio in downtimes, ability to time or outperform market, and lastly, full-time diligence. Cons of management: sizable fees, profit fluctuation with market, and challenges from passively managed vehicles, robo-advisors. Since the mid-2000s, the industries has also faced challenges from two other sources: the increase of robo-advisors, digital platforms that provides automated, algorithm-driven investment strategies, and asset allocation. The latter hindrance exemplify passive management since few investment decisions have to be made by human fund managers. The former challenge does not use human weighing at all, other than the programmer writing the algorithm. As a result, both can charge far lower fees than human fund managers can charge. The pressure from this dual competition is why investment management firm must hire talented, intelligent professionals. Though some clients look at the performance of individual investment managers, others check out the overall performance of the firm. That's all. Thank you for listening.
Hello everyone, my name is Dayan J. Magdalora, your reporter number 3. This is the content of my report. Part 1. What is a robo-advisor? Part 2. Benefits of using robo-advisor. Part 3. Robo-advisor and the SEC. Part 4. How robo-advisors make money. Let's proceed to Part 1. What is a robo-advisor? Robo-advisor are digital platforms that provide automated, algorithm-driven financial planning services with little to no human supervision. A typical robo-advisor collects information from clients about their financial situation and future goals through an online survey and then uses the data to offer advice and automatically invest client assets. The best robo-advisors offer easy account setup, robust goal planning, account services, portfolio management, security features, attentive customer service, comprehensive education, and low fees. It is also a simplified, automated, and affordable. Let's proceed to part 2. The benefits of using robo-advisor. Robo-advisor is low cost. Low-cost alternatives to traditional advisors. It is also accessible. They are available 24/7 as long as the user has an internet connection. Robo-advisor is efficiency. Significant advantage these online platforms have is being efficient. Robo-advisor is low cost. By eliminating human labor, online platforms can offer the same services at a fraction of the cost. Most robo-advisors charge an annual flat fee of 0.2% to 0.5% of a client's total account balance. That compares with the typical rate of 1% to 2% charged by a human financial planner and potentially more for commission-based accounts. Robo-advisor is accessible. It takes significantly less capital to get started as the minimum assets required to register for an account are typically in the hundreds to thousands. $5,000 is a standard baseline. One of the most popular robo-advisors, Betterment, has no account minimum at all for its standard offering. And the efficiency. For instance, before robo-advisors, if a client wanted to execute a trade, they would have to call or physically meet a financial advisor, explain their needs, fill out the paperwork, and wait. Now, all of that can be done with the click of a few buttons in the comfort of one's home. Hiring a robo-advisor. Opening a robo-advisor will often entail taking a short risk profiling questionnaire and an evaluation of your financial situation, time horizon, and subjective investment goals. You will have the opportunity in many cases to link your bank account directly for quick and easy funding of your advisory account. Let's proceed to part 3. Robo-advisor and the SEC. Robo-advisors hold the same legal status as human advisors. They must register with the U.S. Securities and Exchange Commission to conduct business and are therefore subject to the same securities laws and regulations as traditional broker-dealers. Let's proceed to part 4. How robo-advisor makes money. The primary way that most robo-advisors earn money is through a wrap fee based on assets under management or AUM. While traditional or human financial advisors typically charge 1% or more per year of AUM, most robo-advisors charge around just 0.25% per year. In addition to the management fee, robo-advisors can make money in several other ways. One way is the interest earned on cash balance or cash management, which is credited to the robo-advisor instead of the client. Since many robo-advice accounts only have a small allocation to cash in their portfolios, this can only become a significant source of income again if they have many users. Another revenue stream comes from payment for order flow. Typically, robo-advisors will accumulate funds that have been added from deposits, interest, and dividends, and then bundle this together into large block orders executed at just 1 or 2 points in a day. Finally, robo-advisors can earn money by marketing targeted financial products and services to their customers, such as mortgage, credit cards, or insurance policies. These are often done through strategic partnership rather than the use of advertising networks. That's all. Thank you. I'm your reporter number 3, Dayan Hulao Magdalara.
Good day, everyone. My name is Maria Joshan Faith Elsadora, and I am the reporter for Module 1. My report contents are Part 1, Shortcomings of Robo-Advisors. Part 2, real-world example of investment management. Part 3, management investment company. And Part 4 will be the open-end and closed-end funds. Part 1, shortcomings of robo-advisors. When talking about shortcomings of robo-advisors, what comes first to your mind? Is it lacking? Is it a failure? Yes, both are correct. In this topic, we are going to tackle what are the things and expectations that a robo-advisors failed to meet, mainly talking about its defects and weaknesses when it comes to investment. The entry of robo-advisors has broken down some of the traditional barriers between the financial services world and average consumers. Because of these online platforms, sound financial planning is now accessible to everyone, not just high net worth individuals. To explain, these robo-advisors are automated investment services that are very low cost and often have no minimum balance requirements. They also tend to follow optimized index strategies that are best suited for most investors. At some point, they became more popular and very convenient rather than meeting a human financial advisor. But still, many in the industry have doubts about the viability of robots as a one-size-fits-all solution to wealth management. Given the relative nascency of their technological capabilities and minimal human presence, robo-advisors have been criticized for lacking in empathy and sophistication. Yes, still, not all robo-advisors are reliable and can't work successfully and effectively. They also discourages most of the financial advisors, mainly the human financial advisors. Robo-advisors do not offer many options for investor flexibility. An analogy of this is that these robo-advisors work only like this because they are programmed for traditional services only. And that is when they lack human interaction, the empathy, and the experiences emotionally and physically to provide for common investors. They are good entry-level tools for people with small accounts and limited investment experience, namely the millennials, but are far from sufficient for those who need advanced services like estate planning, complicated tax management, trust fund administration, and retirement planning. Pay attention to what a robo-advisor invests in, as many are now moving away from passive index strategies and investing in more risky areas that could underperform the market. So to continue, these robo-advisors only aimed at ordinary investors. In short, they are risky. It is really in need to have an in-depth information and advices for estate planning, tax management, fund administration, retirement plans, and many more. Automated services are also ill-equipped to deal with or unexpected crisis or extraordinary situations. For instance, if a young person's parents passed away and they receive an inheritance, going online to a robo-advisors to manage the money is probably not the optimal decision. These robo-advisors are not like human financial advisor that could arrange and finish the unexpected situations they may encounter. As I have said a while ago, that they only provide traditional investment services. Robo-advisors are convenient to use, but they most likely lack what a human can do and provide. To summarize, robo-advisors are not personalized. You are more than just an investment portfolio for them. They tend to bash advisors' price schedules. They falsely claim they are the only resource for newbies. And most especially, they are no face-to-face meetings unlike with human advisors. The robo-advisory sphere is just getting started. These entrants into the landscape benefit the consumer by lowering fees while contributing many paths to professional asset management. As with any life choice, the investor should figure out what type of investment guidance they need and select a robo-advisor or financial professional to suit his individual style. Part Real-world example of investment management. The top 20 investment management firms control a record 43% of all the global assets under management. According to the Willis Towers Watson report mentioned earlier, some 40.6 trillion US dollars worth. In the US, the five leading firms include in descending order. Number 1, Bank of America Global Wealth and Investment Management, which as of 2008 includes Merrill Lynch, worthing 1.25 trillion US dollars in asset under management. Number 2, Morgan Stanley Wealth Management, having 1.1 trillion US dollars in asset under management. Number 3, JP Morgan Private Bank, having 677 billion US dollars in asset under management. Fourth is UBS Wealth Management, which has 579 billion US dollars in an asset under management. And last is Wells Fargo, with an asset under management of 564 billion US dollars. Part 3, Management Investment Company. A management investment company is a type of investment company that manages publicly issued fund shares. Management investment companies can manage both open-end funds and closed-end funds. A management investment company manages capital for clients through pooled funds. Pooled funds are investment vehicles like mutual funds, commingled funds, group trusts, real estate funds, limited partnership funds, and alternative funds. Investors who commonly contributed to these funds are the retiring boards and investors. So to continue, U.S. investment market legislation has classified investment companies into three categories under the Investment Company Act of 1940. So to elaborate, Investment Company Act of 1940 is an act of Congress which regulates investment funds. So in Section 4 of the 1940 Act breaks down the classification of companies as: first is the face amount certificate company. It is a type of corporation that raises money by issuing investors debt securities of a specified value. Next is the unit investment trust. It is an investment company that offers a fixed portfolio, generally of stocks and bonds, as redeemable units to investors for a specific period of time. And last is the management investment company. It's a type of investment company that manages publicly issued fund shares. Management investment companies can manage both open-end funds and closed-end funds, just like what we have mentioned a while ago. Part 4, Open-end and Closed-end. Management investment companies issues shares of funds from pooled investment. Investors buy shares of funds that incur sales commission charges as well as operational expenses. Funds management investment companies must comply with U.S. securities regulations. Regulations support fair market activities, investor education, and transparency. The funds managed by management investment companies trade on exchanges or through open-end management companies, and closed-end management companies are known as publicly traded investments. Management investment companies offer investors publicly traded pooled fund investment in a broad range of standard and complex investment strategies. Open-end and closed-end funds are both professionally managed funds that achieve diversification by investing in a collection of equities or other financial assets rather than in a single stock, and both pool the resources of many investors to be able to invest in a larger and wider scale. Open-end funds. Open-end management investment companies manage open-end funds. They can be offered as either a mutual fund or exchange-traded fund or ETF. Open-end funds do not have a designated number of shares available for trading. The management investment company can issue and redeem shares of open and mutual funds and ETFs at their discretion. Open-end mutual funds are known to offer a range of share classes. Open-end management investment companies structure share classes with different fees that investors must pay when transacting with an intermediary. Open-end mutual funds do not trade on a market exchange. They are transacted through the mutual fund company. Transactions are processed at the fund's next reported net asset value, or the NAV, also known as the forward price. Exchange traded funds, or the ETF, are traded daily on exchanges. Exchange traded funds can trade at a discount or premium to their NAV, or the net asset value. They may also trade at par value. Management investment company authorized participants actively monitor ETF prices and exchange trading with the ability to create and redeem shares at their discretion to manage price of an ETF. Next is the closed-end funds. Closed-end management investment companies manage closed-end funds. They offer a specific numbers of shares to the market in an initial public offering. Closed-end management investment companies do not create or redeem shares following the public offering. Closed-end funds trade daily on exchanges. They are known to trade at a discount or premium to their net asset value. Moreover, these two funds are different in structure, pricing, and sales. A closed-end fund has a fixed number of shares offered by an investment company through an initial public offering, while open-end funds are offered through a fund company that sells shares directly to investors. And that's all. Thank you, everyone. I hope that what I shared are retained in most of you. Have a great day, and I have a great time also in reporting this. Goodbye.
Hello, I am reporter number 5. These are the topic that assigned to me. First is diversified and non-diversified. Second is investment companies. Third is the federal securities, last categorized investment companies. And the last one are 10 largest investment management companies. We move to diversified and non-diversified. In addition to discussion, open-end, closed-end, management investment companies, Section 5 of the 1940 Act also explains diversified and non-diversified management investment companies. Diversified management investment companies have assets that fall within the 75-5-10 rule. A 75-5-10 diversified management investment company will have 75% of its assets in other issuer and cash, no more than 5% of assets in any one company, and no more than 10% ownership of any company's outstanding voting stock. Any management investment company not falling within the 75-5-10 rule is considered a non-diversified management investment company. In diversified, you receive the highest return for the lowest risk with a diversified portfolio. It is also for the most diversification includes a mixture of stocks, fixed income, and commodities. Diversification works because the assets don't correlate with each other. A diversified portfolio is your best defense against a financial crisis. Next, if we move to non-diversified concentrate their efforts in a single industry or geographic section or sector. You may find banks stock in a bank sector fund or in a financial sector fund. Also with the insurance companies, real estate, and brokerage houses. Non-diversified funds often rise and fall with event and economic condition because those factors similarly affect most business in the sector. With more risk come the possibility of substantial gains if the sector does well. We move to investment companies. Generally, an investment company is a company or corporation, business trust, partnership, or limited liability company that issues securities and is primarily engaged in the business of investing in securities. An investment companies invest the money it received from investors on a collective basis, and each investor shares in the profit and the losses in the proportion to the investor's interest in the investment company. The performance of the investment companies will be based on, but it won't be identical to the performance of the securities and the other assets that the investment company owns. In an investment company is a corporation or trust engaged in the business of investing pooled capital into financial securities. Investment companies can be privately or public owned, and they engage in the management, sale, and marketing of investment product to the public. Investment companies make profit by buying and selling shares, properties, bonds, cash, and other funds of other assets. We move to the federal securities laws categorize investment companies. These companies categorized with three. First is mutual funds, legally known as open-end companies. Second is closed-end funds, legally known as closed-end companies. And the last one is UITs, or legally known as unit investment trusts. Each type has its own unique features. For example, mutual funds and UIT shares are redeemable, meaning that when investors want to sell their shares, they sell them back to the fund or trust or to the broker acting for the fund or trust and their approximately net asset value. Closed-end funds shares, on the other hand, generally are not redeemable. These are the difference between the three categories. Instead, when closed-end funds investors want to sell their shares, they generally sell them to the other investors on the secondary market at a price determined by the market. In addition, there are variation within each type of investment companies, such as stock funds, bond funds, money market funds, index funds, interval funds, and exchange-traded funds, or what we call the ETFs. Some types of company that might initially appear to be investment companies may actually be excluded under the federal securities law. For example, private investment funds with no more than 100 investors and private investment funds whose investors each have a substantial amount of investment asset are not considered to be investment companies, even though they issue securities and are primarily engaged in the business of investing in securities. This may be because of the private nature of their offering or the financial means and sophistication of their investors. For addition information on these types of private investment funds, please refer to hedge funds in our Fast Answer data bank. We move to the 10 largest investment management. Number 1 in the 10 largest investment are BlackRock. BlackRock has $7.318 trillion. BlackRock is not just the world's largest asset manager but one of the world's largest financial institutions. The company was founded in 1988 and went public in 1999. The firm has been influential in advancing the growth of exchange-traded funds, or what we call ETF, through its eShares product. eShares now comprise more than a quarter of BlackRock's assets under management. Second is the Vanguard Group. This has $6.1 trillion. Vanguard is known for its strategy of passive investing. This means that money is placed in mutual funds designed to mirror the activity of a specific index or the broader stock market. Vanguard boasts a low expensive ratio for most of its funds. Along asset management, Vanguard offers brokerage service, financial planning, annuities, and other services. Next is USB Group. It has a $3.518 trillion. USB Group has 4 divisions that operate around the world. The Switzerland-based firm describes itself as the only true global wealth manager. USB offers both wealth management and asset management service. We move to number 4 largest. These are Fidelity. It has a $3.319 trillion. Fidelity is an asset manager and discount broker with more than 27 million customers. It offers an online platform for individuals investors to buy and sell securities. Fidelity also manages entire portfolios on behalf of clients. In the summer of 2018, it made headlines when it began offering mutual funds with a zero expense ratio and minimum investment requirement. Next are State Street Global Advisor. It has a $3.54 trillion. Boston-based State Street is a subsidiary of State Street Corporation. It manages investments for a wide range of institutional clients, including non-profit, local governments, associations, and even educational groups. Next is Allianz. Allianz has $2.530 trillion. This German firm is primarily an insurer. It also operates 2 assets management divisions, Allianz Global Advisors and PIMCO or PIMCO. By itself, PIMCO has $1.92 trillion under management. 7 is JP Morgan Chase. It has a $2.511 trillion. Most people think of JP Morgan Chase as an investment bank, but it also has a robust asset management business. In 2017, it has $1.3 billion in assets moved from BlackRock as part of a new custody arrangement. Next is Goldman Sachs. Asset management is just one of many services offered by Goldman Sachs. The type of clients it serves include hedge funds, bank and brokerage, pensions, endowment and foundations, corporations, and the last one is government. Recently, Goldman Sachs has also branched out into sustainability and impact investment. Next, we move to number 9, Bank of New York Mellon. It has a $1.961 trillion. This company was founded around the same time that the United States first became a country. It was created by Alexander Hamilton. More than 230 years later, BNY Mellon managed investments for individuals and investment in 35 countries. We move to the last, PIMCO. It has a $1.92 trillion. As mentioned earlier, PIMCO is managed under the same company as Allianz. Although it was acquired by a German company, it is a headquartered in California. It continued to operate as an independent subsidiary of Allianz. Thank you for listening. I am reporter number 5.